Something extraordinary is happening in the silver market right now. And if you're not paying attention, you're about to miss one of the most significant moves we've seen in years. I'm not talking about some minor price fluctuation. I'm talking about a structural shift that's been building for months, creating a coiled spring of pressure that's ready to explode. The technical setup is textbook, the fundamentals are screaming, and the smart money, they're already positioning themselves. Let me show you exactly what's happening. Right now, silver is trading in what technical analysts call a compression pattern. Picture a spring being wound tighter and tighter. That's what's happening with silver's price action. We're seeing lower highs and higher lows converging into an increasingly narrow range. This isn't random. This is accumulation. This is institutional money quietly building positions before the breakout. The chart tells a fascinating story. Silver has been consolidating between key support around $30 and resistance in the low 30s. But here's what most people miss. Each time price tests these levels, the range gets tighter. The volatility is compressing. And historically, when you see this kind of compression in silver, what follows is explosive. Look at what happened in late 2010. Silver spent months coiling in a similar pattern. Then it erupted from $15 to nearly $50 in just 6 months. Or go back to 2003. Another compression pattern. Another massive breakout that took silver from $4 to $21 over the next few years. The pattern is unmistakable. And we're seeing it again right now. But the technical setup is only part of the story. What's really fascinating is what's happening beneath the surface in the physical silver market. Because while traders are watching price charts, there's a supply crisis brewing that most people have no idea about. Industrial demand for silver hit a record high this year. We're talking about 680 million ounces consumed by industry alone. That's not jewelry. That's not investment. That's silver being permanently consumed in solar panels, electric vehicles, electronics, and green technology. Silver that's gone forever. Think about what that means. Every solar panel installed contains silver. Every electric vehicle uses significantly more silver than a traditional car. The global push toward renewable energy isn't slowing down, it's accelerating, and silver is absolutely critical to making it happen. Here's where it gets interesting. Mine production? It's barely growing. We're looking at roughly 830 million ounces coming out of the ground annually. Sounds like a lot until you realize total demand is pushing 1.2 billion ounces. That's a massive deficit, and it's been a deficit for 4 consecutive years now. So where's the extra silver coming from? Existing stockpiles, government reserves, recycling. But here's the problem. Those sources are finite. You can only drain the tank for so long before it runs dry. I spoke with a mining executive recently who put it bluntly. We're not finding new silver deposits fast enough to replace what we're consuming. The easy silver has been mined. What's left is deeper, harder to extract, and more expensive to produce. That's the reality of silver supply, and it's creating a structural deficit that can't be solved quickly. Now let's talk about what the big players are doing. Because while retail investors are distracted by daily price movements, institutions are making calculated moves. Central banks have been on a gold buying spree. Everyone knows that. But what's less discussed is how silver benefits from this dynamic. When central banks accumulate gold, they're signaling distrust in fiat currencies. That same distrust drives investment demand for silver, and we're seeing it in the ETF flows. Silver ETFs have been experiencing steady inflows. Not dramatic, not headline grabbing, but consistent. That's institutional accumulation. That's smart money building positions quietly before the crowd notices. Look at the commercial positioning on the COMEX. Commercial traders, the big banks and institutions that actually deal in physical silver, have been reducing their short positions. This is significant. These aren't speculators. These are the players who understand the physical market better than anyone, and they're positioning for higher prices. Meanwhile, the gold-to-silver ratio is telling us something important. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, when this ratio gets stretched, when silver becomes very cheap relative to gold, it eventually snaps back violently. We've seen the ratio come down from extreme levels, but silver still has significant room to catch up to gold's performance. When that catch-up trade begins, it tends to be fast and furious. Silver is the volatile cousin of gold. When it moves hard. Here's something most people don't consider. The paper silver market versus the physical silver market. On the COMEX, hundreds of millions of ounces of silver trade as paper contracts. But the actual physical silver backing those contracts? It's a fraction of the paper claims. This works fine in normal markets. But when physical demand surges and everyone wants delivery at once, that's when the system breaks. That's when price has to rise dramatically to balance supply and demand. We saw a glimpse of this during the silver squeeze movement. Retail investors coordinated to buy physical silver and take delivery. What happened? Premiums on physical silver exploded. Dealers ran out of inventory. The disconnect between paper price and physical availability became obvious. That was a preview. Imagine what happens when institutional money decides they want physical delivery. When sovereign wealth funds decide silver is strategic. When the industrial users who need silver for production start securing long-term supply contracts. The price discovery mechanism in silver is broken. It's based on paper trading that doesn't reflect physical reality. And when that disconnect becomes too extreme, the market corrects violently. Let me paint you a picture of what's coming. We're entering a period where multiple forces are converging on silver simultaneously. First, you have the green energy transition. This isn't optional. Governments worldwide have committed to carbon reduction targets. That means massive investment in solar, wind, and electric vehicles, all of which require silver. This demand is structural and growing. Second, you have monetary instability. Central banks are trapped. They can't raise rates too high without breaking the economy. They can't keep rates too low without fueling inflation. This environment is perfect for precious metals. And silver, with its dual role as both industrial metal and monetary metal, benefits from both angles. Third, you have supply constraints that can't be solved quickly. You can't just turn on a switch and produce more silver. Mining projects take years to develop, and with environmental regulations tightening, it's getting harder and more expensive to bring new supply online. Fourth, you have the technical setup. That coiling pattern I mentioned earlier, the compression, the spring being wound tighter. When this breaks, it's going to move fast. Now, I want to address something important for those of you thinking about your financial future and retirement security, because silver isn't just a trading opportunity. It's a wealth preservation strategy. If you're sitting on retirement accounts worth 6 figures or more, you need to understand how precious metals can fit into your portfolio. I've put together a comprehensive guide on gold IRAs, how they work, how to get physical metals into your retirement account without tax penalties, and what you need to know before making any moves. You'll find that in the description below. It's worth reviewing if protecting your retirement wealth is a priority. But let's get back to the immediate opportunity in silver. The breakout, when it comes, will likely happen faster than most people expect. That's the nature of compressed markets. They don't drift higher slowly. They gap. They surge. They catch people off guard. I'm watching several key levels. If silver breaks decisively above $32 with strong volume, that's your confirmation. That's the spring uncoiling. From there, the next target is the previous highs around $35, but that's just the beginning. If this move has the fundamental backing, I believe it does. The supply deficit, the industrial demand, the monetary instability, we're not talking about a move to $35 or $40. We're talking about a revaluation of silver to reflect its true scarcity and strategic importance. Think about silver's role in the economy. It's in your phone, your computer, your car, solar panels, medical equipment, water purification, electronics manufacturing. It's everywhere. And yet it trades like it's abundant, like supply is unlimited. That disconnect can't persist. Here's what keeps me up at night. What happens when the industrial users panic? Right now, companies that need silver for production are buying hand to mouth. They're not stockpiling. They're not securing long-term supply. They're assuming silver will always be available at reasonable prices. But what happens when a major manufacturer can't get the silver they need? When production lines stop because of silver shortages? Suddenly, price becomes irrelevant. You pay whatever it takes to secure supply. And that's when price discovery goes vertical. We've seen this in other commodities. Palladium went from a few $100s to over $3,000 when automotive manufacturers realized they couldn't get enough for catalytic converters. Lithium exploded when battery demand outstripped supply. Silver has the same setup, but with even more critical applications. The smart money understands this. That's why they're accumulating now, while price is still compressed. They're not waiting for confirmation. They're not waiting for the breakout. They're building positions before the crowd realizes what's happening. Look at what happened in previous silver bull markets. The moves are breathtaking. In 1979-1980, silver went from $6 to $50 in less than 2 years. In 2010-2011, it went from $15 to nearly $50 in about 18 months. These aren't gradual trends. These are explosive moves driven by supply-demand imbalances and momentum. And here's the thing about silver. It's a relatively small market. The entire above-ground silver supply is worth maybe $50 billion. That's nothing in the context of global financial markets. When serious money decides to flow into silver, there's not enough supply to absorb it without dramatic price increases. Compare that to gold, which has a market value in the trillions, or to major stock markets. Silver is tiny, which means it doesn't take much capital to move the price significantly. That's both the opportunity and the risk. But right now, with the setup we're seeing, the risk-reward is heavily skewed to the upside. Let me share something that doesn't get discussed enough: the role of silver in the coming monetary reset. We're watching the dollar's dominance being challenged. BRICS nations are discussing alternative payment systems. Central banks are diversifying away from dollar reserves. This isn't conspiracy theory. This is documented policy. When the current monetary system comes under stress, precious metals become the ultimate safe haven. Gold gets the headlines. But silver? Silver is the people's money. It's more accessible, more affordable. And historically, when monetary systems reset, silver plays a crucial role. Think about what happened in Weimar Germany, in Zimbabwe, in Venezuela. When currency collapses, people turn to tangible assets, and silver, being more divisible than gold, becomes the medium of exchange. We're not there yet. But the trajectory is concerning, and smart investors are positioning accordingly. The technical pattern we're seeing in silver right now, this coiling, this compression, it's not just a chart pattern. It's the market's way of building energy before a major move. Every day that silver stays in this tight range, the pressure builds. The spring winds tighter. And when it releases, history shows us what happens. The moves are violent. The gains are substantial. And the people who positioned early are the ones who profit most. I'm watching the volume patterns closely, because volume tells you when the big players are active. And lately we're seeing volume spikes on up days and lighter volume on down days. That's accumulation. That's institutional buying. They're absorbing every bit of supply that comes to market. The mining stocks are another tell. Silver miners have been outperforming the metal itself in recent weeks. That's unusual. Typically, the metal leads and the stocks follow. When stocks lead, it often signals that informed investors are positioning for a major move in the underlying commodity. Think about the leverage in mining stocks. If silver moves from $30 to $60, that's a 100% gain. But a well-run silver miner? Their profit margins could triple or quadruple. The operational leverage is enormous. That's why mining stocks often outperform the metal during bull markets. But here's what I want you to understand. This isn't about getting rich quick. This is about recognizing a structural shift in a critical commodity market. This is about understanding that the supply-demand fundamentals for silver have changed in a way that can't be easily reversed. The green energy transition alone guarantees growing silver demand for decades. Add in monetary instability, supply constraints, and technical breakout potential, and you have a perfect storm for higher prices. The question isn't whether silver will break out. The question is whether you'll be positioned when it does. I've been analyzing markets for years, and I can tell you, setups like this don't come along often. When you see technical compression, fundamental supply deficits, and institutional accumulation all happening simultaneously, you pay attention. The coiling we're seeing in silver right now is building towards something significant. The spring is wound tight. The pressure is building. And when it snaps, and it will snap, the move is going to be explosive. This is your alert. This is your warning. Silver is coiling for a massive move, and the time to position is before the breakout, not after. Because once this spring uncoils, once the compression releases, the move will be too fast to chase. The smart money is already positioned. The institutions are accumulating. The supply deficit is real and growing. The technical setup is textbook. Everything is aligning for a major move in silver. Don't miss it.